Welcome to the Retirement Made Easy podcast. I'm your host, Greg Gonzalez. My goal for the podcast is to help you live a better life in retirement by giving you the tools and information you need in a language that you can understand. They say knowledge is power, and that's what we hope to share with our listeners on this podcast every single episode. And this episode is going to be no different. On this episode, I wanted to talk about optimism in a bright future, and how optimism and behavior when it comes to investing actually determines your investment results. If you listen to the news, there's so much negativity, and it can really weigh on you. It can weigh on your mind, and it can change your attitude, not only about your investments, but maybe about your life in general, and in your view of the world and the direction that it's heading. But on this episode, I wanted to talk about the last 45 years, kind of what we've been through, and where we stand today, and how much better it is than it was 45 years ago. The path forward is bright, in my opinion. So we'll talk about that on today's episode, and how to be a successful long-term investor. Before we get started with today's episode, I wanted to remind listeners to check out our website, which is retirementmadeeasypodcast.com. That's retirementmadeeasypodcast.com. While you're there, you can download a couple free resources, such as my retirement secret sauce, as well as our 2020 tax planning guide. While you're on the website, at the bottom, you can send me your listener questions. I'd be happy to answer those within 24 to 48 hours. I just love hearing from listeners of the Retirement Made Easy podcast. So check out the website, and you can also listen to previous episodes on the website once you're there. So today's episode, I wanted to look back 45 years to 1975. And I chose 1975, 45 years ago, because 45 years for most people is going to be a lifetime of investing. Assuming maybe you get started when you're in your early to mid 20s, let's say, maybe it's your 30s, and you invest really your life expectancy. So 45 years is a good plug number. So that would put us back at 1975 if we're in the year 2020. And when things get crazy, people forget that they're invested for the long haul. They forget that they have long-term goals, and their investments have to be long-term investments that are positioned to accomplish those long-term goals. But when things get choppy in the economy and the world, we lose sight of those long-term goals, and our retirement portfolio, our investments, might suffer by making short-term decisions. But let's think back. Since 1975, we've been through wars, we've been through terrorist attacks, we've been through assassinations, Y2K, we've been through hurricanes and tsunamis, and the 2008 financial crisis. We've been through a lot. So I wanted to do a little research on how far we've come since 1975, and I used JP Morgan's Guide to the Markets and Retirement Guide, which are available as a free resource online on JP Morgan's website. I highly encourage you to check that out. And both guides were dated September 30th, 2020. And these two guides served as the source of all the information you're going to hear, all the facts and information you're going to hear on today's podcast. So again, check those out. But as far as the values of the S&P 500, the global population I'm going to talk about in a second, it all came from JP Morgan's Guide to the Markets and Retirement Guide. So check that out. But since 1975, the global population is up 80%. Our U.S. economy tripled, measured by real GDP growth. And during that time, the U.S. since 1975 has only had a 50% population growth, but our economy has tripled. In 1975, the S&P 500 index was 90. Today in 2020, on January 1st, 2020, the S&P 500 was 3257. That's a 4,278% increase in those 45 years. That 45-year period, the last 45 years, has probably been the greatest accretion of wealth in this country's history. the S&P 500 index averaged almost 9% the last 45 years. In 1975, looking at the world's population, in 1975, there were only 4 billion people in this world, half of whom were in extreme poverty. Today, there's more than 7 billion people in this world, and only 1 in 10 is in extreme poverty. And you may ask yourself, where did those people go? Well, those people went to the middle class. Their lives got better. So for anyone out there who's saying that as a global world, as a world of human beings, we're headed in the wrong direction, just look back at 1975 and look at what we've come through. To me, optimism is the only reality. And as we look forward and as we plan for a more successful future than we've had in the past, as successful as the past 45 years have been, there are so many reasons to be optimistic about the future. And in my eyes, really pessimism, and if you know those people out there who are very pessimistic about the world and maybe about their future in general, those people, in my eyes, almost have a mental illness. Pessimism just doesn't line up with reality. As I've been discussing for a few minutes here, the last 45 years, things have gotten better. The world has evolved. People have come from enormous amounts of poverty to the middle class. Their lives have gotten better. In the last 45 years, people have been able to accumulate a lot of wealth that was never accumulated before in the past. So I wanted to talk about how most people, most investors, were able to accumulate this wealth over the past 45 years and how they did it. And essentially, most of them kept a long-term focus. Most investments are meant to be held long-term. And that's what so many people forget. Again, I stated in 1975, the S&P 500, which is 80% of the US stock market, it was valued at 90 in 1975, and it opened this year in 2020 at 32.57. That is a phenomenal increase in the US stock market over 45 years. But you've got to remember that these people that were successful investors over the last 45 years, they stuck with it. They didn't panic out. During the last 45 years, the S&P 500 index was down only 8 of those 45 years. The rest of the years, they were positive. Those are pretty good odds for long-term investors. And again, don't take this conversation that I am recommending that any individual invest their entire portfolio in the S&P 500 index. That is not the case. I would never recommend that. We are just using the S&P 500 index as a gauge of the US stock market as a whole. But what I will say is, when I think back, all of the most successful investors I've ever known of or known personally have constantly focused on the long-term rising trend line of the market. And they have ignored the short-term periods of discomfort, like a 2008 when the market pulls back and corrects. Meanwhile, all of the unsuccessful or failed investors that I've ever talked to or met, sooner or later they fixated on the periods of volatility, and they really let it ruin their investment plans and their long-term goals. And that's the damage that can really be done by mistaking a temporary decline for a permanent loss. If my house drops in value by 20%, that's a temporary decline. If it burns down and I don't have any insurance on the home, which would be very foolish, but if it burned down, well, that's a permanent loss, right? But if the value of my house just temporarily goes down, I'm not so concerned because my goal is to hold on to the house long term. So a short-term reduction in the value of my home doesn't really bother me too much. But the problem with investments in someone's retirement savings, let's say, the problem with them is they're liquid. Most of them are liquid by the day. And in that case, sometimes people get scared and they let their emotions get in the driver's seat, and that's when they make fatal mistakes. There was a portfolio manager, a famous portfolio manager named Peter Lynch, that said, it's not the head that determines investment success, it's the stomach. It's being able to stomach the drops in price, the drops in the market, the volatility, the ups and downs, when it becomes a roller coaster ride at some points, essentially what he was saying was, it's the people that can ride the ups and downs in the market that determine who's successful and who's not. That was his opinion. I actually share that same opinion as well, because I believe in buying quality investments long-term and sticking with them as long as your long-term goals have not changed. If your goals have changed, yes, maybe you make changes to your portfolio. But if your long-term goals haven't changed and your investments are still sound, I say stick with it. And there are certain people out there that can't stomach the big drops in value that are associated with maybe mutual funds that are invested in the stock market, for example. And maybe those people, if you can't stomach the temporary declines and the temporary advances, maybe you shouldn't be invested that aggressively or in assets that can be as volatile as the stock market. Maybe you would be better off in more conservative investments. So you've got to kind of decide with your financial planner what side of the fence you sit on. Are these investments really long-term and the temporary price or the temporary volatility doesn't bother you because you know that these are long-term investments that you're going to use long-term, way in the future, and the current price doesn't impact your life at all? Or are you the person that says, I'm losing sleep at night because I'm looking at maybe my investment statement and I'm looking at the price reduction and it's driving me crazy? You have to kind of determine how much risk that you want to take in your long-term portfolio, and that will kind of decipher how it should be invested. There's a study that was done by DALBAR, and JP Morgan publishes this in the Guide to the Markets. It's available online. It's a fantastic report, JP Morgan Guide to the Markets. It comes out quarterly. And in this DALBAR study, they wanted to show how the average investor in mutual funds did the past 20 years. So it looked at 1999 through the end of 2019. And this study showed that the average investor of mutual funds in the United States averaged 2.5% per year during that period of 1999 through the end of 2019. So that 20-year period, a measly 2.5%. So left on their own, people or mutual fund investors get very, very poor performance on average. What was interesting, the same study showed that the S&P 500 during that same period, and that's just the US stock market index, or one of them, the S&P 500 during that same period did over 6% average return per year, and home values went up an average of 3.4% per year during that same period. So if mutual fund investors are doing a lot worse than the market in general, the bond market in general, what are they doing that is resulting in having such poor performance of 2.5% on average per year in a 20-year period? And the reason for their average lower return is they're not sticking with their long-term goals. They're not sticking with the long-term mutual funds. What they're doing is they're getting in and out. They're buying and selling. They're buying when they see volatility. When they see the market going down, they get scared and they sell their long-term investments. Or conversely, maybe the market's going up and up and up and it's hitting new highs. And then at that point, they're buying into the market. But they're not staying put with the mutual funds long-term. That's what the study found. And they would be much better off adding every paycheck maybe to their 401k or IRAs, Roth IRA, that kind of thing, and just kind of looking out the window and letting their mutual funds work for them over time. Or heaven forbid, they're selling their mutual funds and they're investing in gold and silver when things get tough, and then they're holding on to the gold and silver when the market rebounds. And what was interesting, this same study from JP Morgan showed that the Bloomberg Commodity Index, which commodities, think of gold and silver, platinum, that kind of stuff, it actually returned an average annual return between 1999 and 2019 of only 1% per year. So for all these people out there that want to own precious metals, again, if you look at the Bloomberg Commodity Index, it only returned 1% per year between 1999 and 2019. That's pretty pathetic in my opinion. But I'm only basing that opinion on how other investments performed during that same period. And again, we're talking about long-term investments here. When you invest in a mutual fund that invests in some of the greatest companies this country has ever seen, like Coca-Cola, like Pepsi, like AT&T and Verizon and Goodyear and Chevrolet and Ford and Energizer and all these different companies like John Deere tractors. The list goes on. When you're investing in mutual funds, maybe that invest in these different US companies, that is an investment that is meant to be held long term. And really the problem, in my opinion, with pricing long-term investments that are meant to be held on to for years and years, if not decades and decades, is that when you price them by the minute, people are going to be looking at the value every minute of the day and their statements on a monthly basis, maybe. You don't get a statement on your commercial property or your residence every month telling you the estimated price, do you? No, it's because you don't have buyers on the table that are offering to bid on your house to buy it every minute of every day. Imagine if you did, if you had someone every day that would come by your house and offer you a price on your house. You may get a really low bid one day. You'd probably laugh and say, hey, it's not for sale. I'm holding on to this house long term, or I'm holding on to this property long term. So I don't care what someone's going to offer me on a daily basis. Unfortunately, when mutual funds and stocks and other similar investments are priced on a minute-by-minute basis, sometimes there's investments that may be undervalued. And so the price of your portfolio may be all of a sudden down 10% in the matter of no time. But we've just got to remember our long-term goals and just remember that you plan to hold on to long-term investments long-term. The worst mistakes you can make are by selling long-term investments in the middle of a pandemic or in the middle of a recession. I'm a big Dave Ramsey fan, and I heard him the other day on his podcast say that panic is not a strategy when it comes to investments. So when the market gets choppy and you start looking at your retirement savings statements, your retirement accounts, and you're seeing them in the red, that's not the time to panic. That's the time to hold on tight and remember your long-term goals and why you're investing in the first place. By selling your long-term investments at the wrong time really says that you're giving up on your long-term goals, which are really the reason why you own those long-term investments in the first place. With long-term investments, you have to have patience. You're not going to double your money by noon tomorrow. So it's probably best to give them the time that they need and deserve. I hope today's episode has been helpful for you and gives you the optimism of investing in the next 45 years. If you have questions for me, visit my website, which is retirementmadeeasypodcast.com. At the bottom, you can ask Greg a question. I'll see you next time on the next episode of the Retirement Made Easy podcast. And remember, always dream big. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, please consult your attorney, tax advisor, or financial advisor prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. The SmartVestor program is a directory of investment professionals. Neither Dave Ramsey nor SmartVestor are affiliates of St. Louis Retirement Advisors or LPL Financial. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.